The key to the mastermind is being able to talk to people that are in the space, that are doing it, build that camaraderie, build that excitement, talk about their deals. You could jump in as a co-GP to start out if you want to. You don't even have to be the GP. You could start as an LP. So there's a million different ways to really ease yourself into the space, get comfortable with it. And then you can go back to your database and say, hey, I really like this, and here's why.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zana Investments, Tim Little. And on today's show, we have with us Mark Updegraff. Mark is CEO and founder of Updegraff Group Realty, Updegraff Management, Updegraff Services Inc, and Raze Capital. He is an active investor, broker, and operator. As a broker and investor, Mark has been involved in over $200 million in real estate transactions. Mark, welcome to the show.
Thanks so much for having me on, Tim. This is going to be fun.
Yeah, I'm super excited to have you. So I gave everyone a very high-level overview of your extensive background, but on this show, we really like to get into the details of how you got started on your journey. So please take us back to the beginning and tell us how you got to where you are today.
Yeah, I come from an entrepreneurial family. My father was in the trucking industry, and I watched him build his business very painstakingly and very slowly. I remember sitting around the dinner table most nights, and my dad would be working, and we'd see him for dinner on Sunday, and we'd get a family vacation out of him each year. But other than that, he was pretty busy working long, long hours to really build that business. He didn't hire his first employee until I went to college. And throughout my youth, I'd hustle a lot with lots of different side things to make some money. Started from a very young age, picking strawberries and polishing the chrome on my dad's truck and his friends' trucks. So I always kind of had that entrepreneurial spirit. And my father would always say, work smarter, don't work harder. And they also said, go to college, get a degree, get a job, because they're old school. Went to college, followed that advice, and went into industry, started making some money, realized it wasn't as much as I thought I'd be making with a bachelor's of science degree. So I went back and I got some more education, came out with an advanced degree, and I was making significantly more, not double, but pretty close. And I still wasn't really satisfied with that level of income because I had started investing in real estate as an active investor, first purchasing just a single family home, fixing it up, doing the value add myself, a little bit of lipstick, some new kitchen cabinets, some paints, refinish some hardwoods. And it was a really fun and exciting process. And I wanted to do it more because I liked receiving those checks. And I realized that the power of passive income. I was getting these checks every month. I had great tenant. I was getting good reviews, and I wanted more of those, but I was limited in my purchasing power by my W-2 income. And I could see it just wasn't really planning the way that I thought it would, as far as being able to earn income, put it into passive investments. I talked to one of my colleagues at ITT Corp, and I was a scientist, and I said, hey, I'm fresh out with my advanced degree. I can go places here, right? As long as I stick with it and I put in the hours and I put in all the hard work, I'm going to be making some good money. And he explained that as a scientist, you really don't make that much money. He was only making maybe 20, 25 grand more than me. He had been there for 30 years. And he said, I pretty much have hit the plateau where they're not going to pay me anymore. I might get a very meager raise each year, but it's not substantial. It isn't. He explained that if I wanted to make more, I could get into management. And so I explored that side of the business a little bit, hanging out with my manager and talking to him about what a path would look like on the management side. And I shadowed him, and I went to a lot of meetings, and I realized that there was a huge disconnect between the management of a big corporation and then the engineers at the big corporation. The engineers are pretty forward thinking, and they could see the need for new technology. And that's their job, right? They say, hey, look, the landscape's changing. We need to be innovative. We need to develop these things, and we need to get them into the marketplace. On the management side, they're like, no, we've got a system that works. We're making money. We don't want to pivot. We want to continue to rock this and keep just making these good profits. What you're doing, the margins are much smaller. We don't want to do it. So if you think of what happened to Kodak, I could see a similar thing happening to ITT Corp, which had purchased part of Kodak when they were starting to go through their bankruptcy, the space systems division, and they were following the same footsteps of Kodak in that they weren't having the foresight to pivot when they needed to pivot. In Kodak's example, they had the first digital camera. They had the most valuable patent ever, the Bear pattern, on CD array, which every single digital camera that was ever manufactured had to pay them to use that technology. And they bet on film in emerging markets. That was their big bet. When the engineers are saying, hey, let's really push on digital, it's new. They said, hey, digital is really expensive. And we've got all these emerging markets that are going to buy our film where we've got huge margins and we're just going to stick with the film and rake in all this cash. The emerging markets said, we don't want film, we want digital. And so now Kodak's behind the eight ball and all of their competitors are coming out with all these digital products. And now Kodak isn't even on the radar if you're going to buy a digital camera. You know, you're buying a Nikon, you're buying a Canon, you're buying a Fuji, but you're not buying a Kodak. So they really blew it. You know, they had it and they just lost it. And I can see the same thing happening at ITT because we're like, hey, we want to work on this video quality metric, for example, and we can really show you in real time where your video quality is degrading, which if video data, it's a lot of data. It's hard to be able to do that. But we came up with a metric that we could use and we could implement it in the stream. And they just didn't care. They're like, whatever, you guys push you off in the corner and not really invest in you or not really take your technology to the next level. So they lost a legacy contract. I ended up getting laid off with 2,000 other people in Rochester at the same time that Xerox was laying off and Kodak was laying off. And so imaging scientists were a dime a dozen. And there was absolutely no way I was going to find a career in Rochester in the field of imaging. I'd have to move. And my wife, she likes her career here. And I had all these rentals, right? I probably had a dozen rentals at that point, and I didn't want to just abandon what I was doing on the rental side. So I had a crazy idea that I would get licensed as a realtor in order to replace my W income. And what happened from there was I realized that I could make a lot more money as a salesperson than I could as an engineer or even as a manager following that management path, right? It was the harder I worked, the more money that I could make. Now, it didn't happen overnight. My first year in sales couldn't really pay the bills that like I would like to. I was definitely making less than my W-2. My second year, I was getting close to my W-2. By my third, fourth, fifth year, I just had exploded my sales. I was up to 10 million in sales in 1 year, which is a really good wage if you're living in Rochester, which has a pretty affordable price tag as far as living expenses go. So I was able to take all that extra money, triple my salary that I was making, and invest it into my companies and invest it into more passive investments. And really that just that whole process, just I became obsessed with real estate really probably since I bought my first rental. But I knew that I had to keep making money. So I stuck in the W-2 until I got laid off. And then it was like, okay, I'm just going to jump into real estate, sink or swim. And if I sink, then we can pivot and I can find an imaging job maybe in the DC area because there are plenty of imaging jobs, just not in Rochester. But it worked out for the best and I've made it my career and I love it.
Yeah, and such an interesting story. There's a lot of parallels that I hear from your journey and my own. But the thing that stuck out to me was really that whole idea of this is the expectation, especially like my background, my parents' background, very blue collar. And so it was the whole make more than I did by going to college and then getting a good job. I chose to go into the army instead, which probably wasn't the best choice for making money. But at the age of 18, I needed that discipline anyway. So it was a wise choice. But then I did follow that advice and said, okay, I'm going to go to college. And then I went back into the army again. But after that, I was like, okay, now seriously, I want to get into an organization that's more a meritocracy. Because in my head, once you get into corporate, then you will get paid commensurate to the quality of your work. And I think it was a rude awakening for me to bump up against that realization that, hey, no, they don't just exponentially increase your pay based on how good a job you do. It's at your annual review. We'll see if we can give you your 2 to 5% raise. And I remember at one point that, which was like my point where I was done, was where I got promoted and they gave me a new title and no raise. And I was like, what, what is going on? And so I think it just goes back to that whole thing of sales. If you're not familiar with sales and never been exposed to it early on, whether through parents or early jobs, you just don't realize the potential there compared to that more traditional route of go to school, get the job, then try to get a management track, which will somehow make you successful. And yeah, and not to say that sales is easy, and it's certainly not for everyone, but relatively unlimited potential compared to what I discovered was the very limited potential of that more traditional track was jarring for me.
Yeah, absolutely.
Yeah, and so some of the other things you talked about, it's interesting that you mentioned that you were limited in your purchasing power by your W-2. I think most people take the opposite tact on that and they say, "Hey, I need to make more in my W-2," or they say, "I need my W-2 so that I can continue to buy or invest in rental properties." But I guess you were getting so excited about the prospects of real estate, it sounded like that you're like, "I don't have enough money to put in as much as I want to into real estate." Is that accurate?
Yeah. That's accurate, yeah, and I do get that feeling, right? If you're leaving your W-2, now how are you gonna qualify for a loan? Luckily, I had a little bit of a portfolio built up that when I went to the bank, they didn't necessarily force me to have all those tax filings that maybe a typical self-employed person would need to qualify for a loan. They gave me credit for some of that passive income that I was earning, and then they would give me credit for some of my sales that I was doing, so I don't really think they made me season like the 2-year period that they might for a restaurateur or somebody that's doing a more conventional business. I was pretty much off to the races on the lending point because I had the cash to close sitting in the bank account and I could show some passive income that had already been established over multiple years. At that point, it had probably been 4 or 5 years of building that portfolio, building that track record, and then working with a local institution that had been able to get to know me over those 5 years and listen to me and see what I was doing and really appreciate my plan and wanna work with me.
Yeah, and I think that's a really important point. Yeah, if you're 6 months into your first deal and you don't have that consistent income from a W-2, yeah, you may not be as likely to get a loan. But if you have these more seasoned properties and they show proof of this income, and like you said, which is super important, is establishing that relationship with those banks or credit unions that you've probably gone to on a repeated basis. They have trust in you, they understand your deals, and they know it's gonna be okay, then you're a lot more likely to get loans that way. So there's that balance, and I think that's why I recommend that people, if they're gonna get started in real estate, they do it while they do have that consistent income so that they have the opportunity to get those first couple of properties to build that track record, I think.
Yeah. Yeah, I advise my new investors if they can, if they haven't used their FHA loan, your first purchase as a new investor that doesn't own an asset currently, use your FHA loan and put it into the best neighborhood that you can get into because you're only going to have to bring 3.5% down to the table. Your next one, you're going to need 25% down. When else are you going to be able to buy a class A asset and get it into your portfolio if you don't buy it with your FHA loan? You're probably going to be building a portfolio for a couple decades before you're like, all right, I'm comfortable enough to go into class A because I can't afford it. I can't justify it. I got to buy class B, class C. So I usually tell them that. And when they listen to me and they do it, they'll usually trade that up in a couple years. And because it was class A, it appreciated a lot more than maybe a class B or C. And they can take that profit. And because they lived in it, there's no capital gains. And then they can roll that over into their next purchase. And at that point, they're usually thinking, hey, I'll get an investment and I'll get my own single family where I don't have to live with other people.
Yeah, and I tell either former or current military folks the same thing, especially the younger guys, like, and girls. If you got that VA loan, like, use it because it's an
Use it.
amazing asset to have. Like, oh, because then you could do 0 down. Now, obviously,
Yeah.
that's gonna make the mortgage payment higher, but that makes sense. But a lot of people don't realize that you can use a VA loan up to a 4 unit. So
Right.
that's huge right there, especially if you're able to count the income from the other units, so that it helps you qualify.
Mhm.
Huge opportunity there for the live in, the house hacking, which I beat myself up every day for not having done myself, but that's why I preach to others to do
Right.
it.
I didn't do it either. So I'm right there with you. I wish I would have in hindsight.
Yeah. Yeah. I bought a house in DC, and don't get me wrong, like the value went up, but I wish I could have gotten bigger. But at the same time, when you're in really expensive markets, that makes it more difficult as well, right? Like
Yeah.
to find a duplex or a triplex that makes sense in a very expensive market.
Yeah. I'm lucky that Rochester's a little bit of an anomaly. For the most part, they could be at least cash flow neutral, even in a class A. Today, that's not the case, but back then it was.
Yeah. And okay, now you started with those single family homes, I'm assuming. How many
Mhm.
of those did you have? And at what point did you transition and what did that transition look like?
Yeah, so I'm an opportunity buyer, so I wouldn't even say that I'll ever transition. I'm gonna look at any opportunity that I can find. Obviously, as I've grown, I start to gravitate towards what I'm looking at, but if something comes across my desk, I'm not gonna not look at it, even if it's still a single. There's just a lot of opportunities to make money, and the holy grail is when you can pull all your money back out, you can still cash flow, so your return is infinite. So if I can do that, even if it's a single, I'm gonna do it. And it's hard once you start doing foreclosures to not do them. So I'm constant. I love going to the auctions, especially like the big city tax auctions where there's like 1,000 properties that are getting auctioned off in one day. And you've got to do like a month of due diligence. And I just kind of get into that. It's just a fun process. And I'll still do foreclosures at the steps on a regular basis. Now, the larger multifamily are much less likely to come through that way, but they do come through. So you got to keep your eye on everything that's going on for opportunities. Working with wholesalers, I'll do direct mail campaigns. I'll have a lot of different marketing avenues to be able to get the phone to ring to source deals that aren't on the MLS. I think that's the best approach. Have multiple avenues to source deals. That way you never hit a dry spell. You're constantly trying to get something closed. And if you don't have the funds to take it down, then you can start to think creatively. Could I JV this? Could I syndicate it and start looking at some of the more advanced strategies?
Yeah. And so it sounds like you explore whatever means by which to get the deal done, going that creative financing, or like you said, JVing, syndicating. And you talked about even doing foreclosures on like commercial sized multifamily properties. Can you just give me an example of that? Because I've really never heard of anyone doing a foreclosure with a commercial multifamily before.
Yeah, it's the same process as a single family. So I just did a 6 unit, which is commercial. Anything over four is going to be commercial.
Mhm.
It might have been a 7 unit. And it was up on Lake Ave near the lake. It was a beautiful old mansion. It had tenants that have been in there forever paying rent. And the owner, he didn't have his financial ducks in a row. And he had been losing properties over the last decade. This was one of the last ones to get lost. And of course, with COVID, he held on to this thing a lot longer than he should have been able to while he kept collecting rent and not paying anybody. And the process should have been smooth. This particular owner was a little bit difficult in that he has tried to sue everybody under the sun, thinking that there's something fishy is going on with the foreclosure. No, man, you didn't pay your bill. That's why you got foreclosed on. So I did have to enlist my title insurance. I know a lot of foreclosure investors that have never purchased title insurance and they've done thousands of transactions. They tell me, look, Mark, I save $1,000 on every single transaction. I do 1,000 transactions. That's a lot of savings on title insurance. And I've never had an issue. Of course, like I've done a fraction of their volume and I've already had issues. In this, I had to get my title company involved to represent me through these lawsuits that he was bringing for discrimination and unjust foreclosure or whatever, which was nice. But then he also threw a caveat in there that he wanted to sue me because he alleged that I stole his personal property, $500 million or $500,000 worth of personal property. And the title company said, we're not going to cover that claim. You've got to hire your own attorney to do that. So I did end up having to shell out some cash to defend myself. So that was a commercial transaction. Typically, on the bigger stuff, it's going to depend on who owns it, right? So if you get too big and there's a bunch of different owners, then it's probably not going to be like that. And so they may have really, there may be investors that come and swoop in and deal directly with the bank or the lender, and it doesn't actually go to auction. So there are those kind of caveats, but the commercial are a little bit more infrequent. I would say a very maybe 5% of all the foreclosures are going to be in that space.
And I guess with that, is there less competition from the bidding side as well? Because I know a lot of folks are into the single family when it comes to foreclosures, but there's probably, I would assume, that play in the larger properties.
The same guys typically play in all the foreclosures. It's a volume game. So the foreclosure
Mhm.
investors, 80% are going to be winners, 20% are going to be losers. And they go to everything and they're like me, they're just looking for opportunity. I would tell you, yeah, it was only me and one other guy bidding on a 7 unit. And unfortunately, some people that show up to these, they try to cherry pick and they just show up for a one-off. I'd never seen this guy before. I think he just came for this one particular property. And if you don't run title or have somebody run title for you ahead of time, you're not going to know what's not getting cut off. And I think he bid me up a little bit more than I thought that the property should be at, given that there were some outstanding things that I had to take care of after the foreclosure settlement. I think there's an additional $60,000 that went on top of the foreclosure, and it really squeezed my deal. I still took it down, but I was upset. And I'm looking at him like, do you know there's another 60 grand on top of this that we're going to have to pay? I don't think he knew that. So you do have to know what you're doing and be willing to walk away. These guys will go in and dump stuff on people because they know they don't know what they're doing and they don't want to see them back at the auction. So if you come into the auction and you're coming in there for one particular property to cherry pick it, these guys are going to run you up, and they're going to know that you're there to buy it, and they're just going to run you up, and they're going to run you up and they don't care. And then they're going to drop it on you and you're going to pay through the nose for this risky investment. So it's a volume game. You've got to go. You've got to know the players, and if there's something that somebody wants, you could do the same thing to them. But then nobody wins. So there's no agreements between people. But you don't want to be fighting everybody on everything because then nobody wins. But competitive properties are just competitive. So I'm seeing stuff at the foreclosure that's going for prices that you wouldn't have seen years ago. And there's definitely a lot more people that participate in the space. When I started, there'd be two or three bidders, and it was always the same couple people. And now today, there could be 20 to 30 people sitting there. And maybe they're not all bidding, but I would tell you there's a solid 10 people that are bidding on pretty much anything that makes sense.
Wow. Okay. And so going back to some of the other stuff that you're doing, talk to me about like your first syndication, for example, because what I see is that there's like a clear line with most real estate investors, and most of them stay at that, single family, small multifamily scale, and they're comfortable there. And there's almost like a mental block when it comes to the
Mhm.
larger properties. Not because it's mostly because they don't know how to do it, because they haven't been introduced to syndication until you go to something like an event or a
Yeah.
convention where you're like, oh, okay, I get it. But before that,
Yeah.
you just don't know. You stay at that lower level.
Yeah.
Talk to me about how you made that jump and what
Sure.
inspired you to make that jump.
Yeah, so I fall prey to the same thing. Always knew what syndication was, but I never really thought that it was something that I could do. And I went down the rabbit hole of listening to all these commercial real estate podcasts, which got me into some syndicators and some capital raisers and just listening to all their content. And then I'm like, I haven't really continued my education the way that I should. Of course, I'm always doing these real estate related continuing ed things, but I'm not getting any value out of it. Going into this year, I set some pretty lofty goals. And one of them was get down to some conferences, meet some capital raisers, meet some syndicators, get to know them. And that really just woke me up. I was like, I should have been doing this 10 years ago. As I was part of the Bigger Pockets community, I really have no excuse, but I didn't. I was like, I got a good system. I'm making money. I'm helping people. I'm training people. I'm mentoring people. I was comfortable doing what I was doing. And I set good goals. Like I'm developing a 10 unit property myself as the general contractor, as the GC, as the developer. And I thought in my head that I was like taking these steps and stepping up. And now I realize that if I would have just met more people sooner, I would have realized that maybe I should be thinking about things differently. And so that was a huge eye opener. And I have done a lot of JVs over the years, but I've structured them in a way that was very equitable for all parties, right? So I was almost giving away my services for free and bringing in people that had the cash and saying, "Hey, let's do this together. You've got the cash. I know what I'm doing." And the third, or if there's four people, 25, 25, 25, 25, and
Mhm.
really just like doing it for free. And so I'm like, I've been doing this for free for so long. What am I thinking? It's a valuable skill set that I have. So I really need to capitalize on that. So just since going to that event and networking with everybody and getting the proper legal structures set up, there's a learning curve, but all the information's out there. And most people in the space are willing to pay it forward because they realize that they've had a lot of help getting to where they are. Just like when I'm helping somebody that's beneath me, like I don't do it to get paid. I do it because they need some help and I'm happy to assist them if I can. I like to see people succeed. So just networking, LinkedIn is a great place. Joining masterminds, you might think it's expensive at first, and go to the event that you're thinking about joining that mastermind, right? They all have their events. You can meet some people that are part of the community, and really the values in the community, more so in the modules or the training. Like you can figure all that stuff out. That's not the key to a mastermind. The key to the mastermind is being able to talk to people that are in the space, that are doing it, build that camaraderie, build that excitement, talk about their deals. You could jump in as a co-GP to start out if you want to. You don't even have to be the GP. You could start as an LP. So there's a million different ways to really ease yourself into the space, get comfortable with it. And then you can go back to your database and say, hey, I really like this, and here's why. I've invested some money. I did really well, and now I'm going to go off and I'm going to be the GP, and I want to bring you guys in on it and check out this deal. It's really cool. So I think getting your feet wet that way is a really smart approach.
Yeah, and I totally agree, especially on that point about masterminds. When you're starting out and maybe you don't have a whole lot of capital to work with in the first place, yeah, the cost of some of those masterminds does seem excessive, or even some of the training programs that also have a mastermindy aspect to them. But I think you're absolutely right that the value is more in the community and the network itself. Granted, the training may help shorten the learning curve a bit, then that's 20 less podcasts you need to listen to because it's all
Mhm.
concentrated in this one video or something like that. And but it's those people in there that you're learning the nuances that you wouldn't get from a module or a class. And it's those people that are going to be your next partners on that next deal. Or they'll come to you and say, hey, we need someone in on this deal. We know you've done this before. Do you want to come in with us? So I think that's invaluable because that is what really catapults your growth. Learning is important, but if you can't find people that you know and trust and who are willing to do deals with you, then you just stagnate or grow very slowly.
Yeah. Yeah, the mastermind has definitely propelled my growth. I went through all the modules really quick within the first week of joining and got all that foundation. A lot of it was stuff that I already knew, yeah, coming from brokerage and sales and marketing. They talk a lot about your back end and your funnel and your marketing and your lead conversion. And then they dive into the different structures that you can have, the legality. And so it's really good to get that base. But yeah, like you said, it's really in the people because it's so nuanced, right? Everybody's doing something that's slightly different. You're never going to find
Mhm.
two deals that are the same, that are structured the same. So being able to see some deals and talk to some people that are doing them and really understand how it is that they're structuring it, and you can say, okay, that's now it's making more sense now that I can actually see a real example and can talk to you about it. You're doing it.
Yeah. And at the front of the show, when I introduced you, we talked a lot about the different companies that you have. Please talk to me a little more about vertical integration. And I think people intuitively know why it makes sense to vertically integrate, but how did you know when it was the right time to build that next facet of your business or next level of your business?
Yeah. So I think I luckily had some foresight in a lot of what I have done in real estate, and that's to be able to control my own destiny. And so at the very beginning, when I was purchasing these assets, I knew right away, I'm not the manager of the property. Like I can't do that. If a tenant comes to me with any kind of hostility or just like whatever it is, I'm not the right person to respond to that. I'm going to make the situation worse. And if I have great tenants, that's great. Like it's a great relationship, everything works out. But if I have a jerk, then it's kind of like I'm going to be a mirror and I'm going to be a jerk back. So I interviewed a bunch of property managers because I was getting to the point in my career where I couldn't manage and sell and value add, asset manage. I couldn't do all those things. I didn't have enough time and I needed to offload the management. And so I interviewed all these people in Rochester and I was like, I don't trust any of them. I was scared to death to leave my assets with them. I was like, this is going to be a disaster." So I made the conscious decision to build a management company from the ground up. And I knew it was going to cost a lot of money because you've got to have a certain amount of payroll in order to accomplish property management. And if you don't have enough units under management, it's not going to offset that payroll. And you can't build a successful company with a few part-time people. You really need some full-time employees that know what their roles are and know what their responsibilities are and that have free reign to do what they need to do. So I did that early on. And when I did it, luckily, because I had the sales going, I had a lot of people that were coming to me and saying, I want to invest in Rochester. I was active on Bigger Pockets. So I got a lot of leads coming through that source of investors that I could say, look, this is what I've done. These are my pro formas. This is the historical performance. I can show you my T12. This is a great place to invest. And they're like, sweet, sign me up. So I would help them broker the deal. And then we would put it under management because they were like, we need a good manager. And I'm like, yeah, I think I'm the only good manager here in Rochester because I haven't found one. So we would take them under management. And then over the years, we've built through that organic sales side. But then we've also had people coming from nightmare experiences with other managers where I hate to say it, but like these managers will say they're doing work and they're not doing any work. They're stealing the money. They'll say that they're not collecting the rent when they're collecting the rent. Maybe it's cash or whatever, and they're just pocketing it. It's a nightmare. We've done a lot of that, and we've done a lot of fine tuning and tweaking over the years because managing property is extremely difficult. And so I got lucky in that I built this company early on and I learned the systems and I got a good infrastructure and I got a good team and we've got good processes and procedures that I was just naturally vertically integrated and that luckily. So I would tell you that the advantage is you can control everything. You're not subject to a third party. You know what's happening. You don't have to worry that somebody's lying to you or there's a lot of finger pointing, right? It's like the PM points to the contractor points to the vendor points back to it's like, you can't figure out who's screwing up and why things aren't happening, but if you control it. I did that early on. And then we did the same thing on the services side for the same reason, because contractors are tough to control. They want to be on their own schedule. You can't tell them where to be and when to be there because they're contractors. And being able to put out fires or say, hey, we need 3 guys over here now to do this. We had a fire or whatever it is, to have that ability is huge. If I got to rely on a contractor and they're like, yeah, I'm booked out, or if you want me to do it right now, sure, I'll do it. The cost is like 4 times what it should cost because they know you're in a pinch and you can't find anybody and they got other work to do. So that's the price, take it or leave it. So I've built that services as another vertically integrated component so we can really control the full experience for the owner, all the way from acquisition through management and then also the service side of things where we do have preferred vendors that we work with. We can't do everything, but we have enough people on staff on the maintenance department to handle all the turns, to handle all of the maintenance requests, repairs. And then on the services side, we have a big enough staff where we can handle major ticket items. We can quickly do bathrooms, kitchens, flooring, windows, and then the bigger stuff like roofs will sub out, but we have preferred vendors. And so we know what the pricing is. And if one guy tells us the price, we're like, we've got 2 other prices coming in. We can really keep that pencil sharp and we can keep the numbers low for our clients.
Yeah. And I think all of that makes sense from everyone who's listening. They're probably nodding their head in agreement. Yeah, property management sucks, especially like at the lower levels, has been my experience, anyways. The larger you go, the more professional the property management becomes. Just again, economies of scale, right? They can hire full staffs to make sure they got 2 leasing agents and 2 maintenance guys,
Yeah.
whatever the case may be. But once you get to the smaller levels, say 50 and below, 50 units and below, it is really hard to find quality property management. And I think most owners would be like, yeah, that's it. I would love to start my own property management company. But I think the concern is exactly what you brought up, that whole, how do you have enough to offset the cost of the staff? So at that same time that you were starting to create your own property management company, were you also in sales mode with other owners to say, hey, I'm starting this thing. If you need property management you can trust, I'm going to have that. And that way you were able to build up like a client base that kind of was able to
Yeah.
supplement upfront.
Yeah. I built it as quickly as possible. I didn't even go on payroll until just a few years ago. So all my services were always free because that's just what it takes to start up a business. And yeah, I would say that it's going to depend on your MSA and how much you're charging. But I think a good rule of thumb is you're probably going to be looking around 150 to 200 units under management in order to really have enough of a buffer that you can have payroll and you can have all your technologies that you need and you can be able to run a successful management company. And if you're under that number, you're either going to have really poor service because you're skimping out on what you need to do the job. And that's going to give you a bad reputation. Then you're going to have people leaving, or you're going to have to subsidize the business in order to bring yourself up to that level. So when I was subsidizing, obviously my labor I could throw in there and I knew that eventually I could get an ROI, but it was painful. I'm not going to lie. It's a lot of work and people don't really appreciate what we do in the property management business. And there's not really a lot of profit in it anyway. But what you do get is you get a really good system where now your assets are performing better. Right. So it's a win-win because those owners are happy, those tenants are happy, we have less turnover. A lot of the property management companies that are poor, they make a lot of their fees just on turnovers and they intentionally turn stuff over. So they love it when a tenant moves out and another tenant moves in because they're getting that lease up fee. So there's a lot of you got to watch out for that in the business. And I would tell you, like, even if you're talking about large multifamily, there is a problem with managers, even when you get up into that scale. And I don't know for sure, but I would say it's like a scaling thing, right? So if you're a large operator, manager and you've got hundreds of units or maybe thousands of units, you're getting bigger onboarding and offboarding bigger things, right? So maybe there's a sale and you lose 200 units. And maybe there's a purchase and you onboard 200 units, right? So you've got these big swings in unit counts. And let's say that we're going through a boom cycle and everybody's buying and everybody wants management. And you're like, sweet, give me the management. And you stack up 600 units that you didn't have before. It's really hard to staff up that far for 600 units. And yeah, you're going to get a little bit of built in people that come with the apartments, with the complexes, but you're not going to have your key personnel are going to be stretched too thin. And then you're going to have to get people trained. And that process takes time. You might have some turnover on that to get the right personnel in that place. And so I think the owners end up suffering when property management firms are scaling up quickly. And I think that does happen on the large multifamily front. I've talked to a few operators that have trusted large property management companies thinking that same thing that you said. Oh, it's a big company. They're operating at scale. They can do it. And I think they just took on too many units. His property, I think there were 400 units total. When they purchased it, their rents dropped like 40% and their occupancy dropped like 50%. And it just like completely crushed the deal to the point where they're about to lose it. They had to capital call and it was a nightmare. And I don't think he properly vetted the manager and he jumped into the plane, went to look at the building and he's telling me these stories. I'm like, how did you not know this before you bought the property? You should have known this. If I'm buying something, I'm doing all that due diligence as part of my job, but maybe he just was a relatively new operator. I'm not sure.
Yeah, and I think that's another important point that you brought up that some people don't think about in terms of, yeah, if you have several properties, those fees like really start to add up, even assuming that they're doing everything with integrity, which you're probably also right that a lot of times they're not because it's beneficial to their business model to promote certain things, like you said, with turnover and stuff like that. So if you do it yourself, you're going to have one, hopefully you're running your own organization so that's efficient and
Yeah.
not promoting stuff like turnover or excessive maintenance fees, stuff
Yeah.
like that.
We align our model with our owners. So we cut back our lease up fees to basically break even at best. That's if it's not a difficult leasing either season or location. We could easily be losing money on some of the lease up fees. And we do that to show them that we're aligned with them. We don't want to turn these over. We want to get you a tenant that's going to stay because that's going to make you more money. You're going to buy more properties and it's going to keep our operation easier, right? We don't want to have a bajillion turnovers. Turnovers are very complicated. And I think that's why a lot of property managers fail because if you have too many turnovers, you can't have the maintenance staff to deal with it. You can't. It's too intense because it all happens within a couple months of the year, right? So how are you going to get all those laborers for 3 months to do 1,000 turnovers? It's impossible. And then those units sit vacant. And so now you've got vacancy showing up that you really shouldn't have to have. So having a property manager that if they align their model with you, you should be able to tell. You should look for things like that, like a low lease up fee and other, but you also need to realize that if it's too good to be true, it probably is. And if they're offering you like this severe discount in the marketplace from what other people are offering, then there's a good chance you're going to get a discounted service. And then that's going to come with a price tag as well. You'll have higher vacancies, higher turnovers, et cetera. So it's tough. But I think if you interview who you're going to be working with, you come and you meet your staff, you meet their staff, that goes a long way.
Yeah, and I just hope that people understand that property management can make or break your deal. And as the owners, you need to be prepared to move on from a property manager who's not performing. It's never fun. It can be a painful process, but we've done it because you have to for the benefit of the deal and that of the investors who invested in said deal, right? Because you
Mhm.
need that asset performing as well as it should or could. And when it comes to that vertical integration, have you delved into the development side of things too?
Yep,
Yeah.
I'm repurposing an office building. So it was turn of the century construction. It was a furniture manufacturing. So it's built like a tank. It's all made out of concrete. It's awesome. And in the 80s, a architecture firm bought it and they refacaded it. They put in new windows. They turned it into an office. We are converting it from office to multifamily, and we're going to keep a section of it on grade for commercial space. We're going to keep a little bit for the agents to be able to go and hang out and make copies and have some workstations, but not a ton of space. And then the rest is going to be luxury apartments. It's in the downtown and it's got parking. So each unit will come with two parking spaces. They're only 650 to 725 square feet. So that's a ton of parking for the square foot. And we're really excited. We've got the demo completed and we're about ready to have the framers head over and start putting up some walls.
Yeah, and I guess especially right now, the biggest question I would have is how do you go about finding good people? Because especially on the construction side, which is always in demand, even contractors are having trouble keeping the staff to get
Mhm.
things done. How are you navigating that?
Yeah, there was a huge spike in wages to keep people through COVID. So definitely my payroll cost has gone up significantly. I tap into my network of professionals that I know a lot. So if you know a lot of other people in the space are doing what you're doing, it's friendly. There's not a lot of us. I'll just reach out and say, hey, do you have any new framers? Do you have any new plumbers? Do you have any new electricians? And then just keeping that Rolodex filled. So when I put somebody in, I'm going to tag it with the category. So when I go to my phone and I type in electrician, I'm going to get 20 different entries of people that either somebody else has vetted or I've vetted, and then just using them on projects over the years, you start to build notes about how they perform, how much they can handle, how many staff they have, and that's been a good resource. So it's just networking and then keeping everybody in your phone and keeping on top of touching bases. We like to send out cards to our vendors for Christmas, and we'll have a little party where we invite them for an open house. So kind of keep it like family oriented.
Yeah, so it's not just about the pay, although that's obviously important, especially nowadays, but it's how you treat them.
Yeah,
Yeah.
they're looking
So
for consistent work, right? So if they know you're somebody that writes the check when they send the bill and
mhm.
provides them work year round, they're going to love you and they're going to want to get your business, and that's going to keep the pencil sharp because they're going to know that, hey, if I fall, I know he's got a Rolodex, and if he stops doing business with me, then I might not get back in there. So I got to make sure that I keep him happy, but we know that they need to pay their bills too.
Yeah, and this has been some super insightful discussion, but we do need to move on to the turbo round. So I'm going to ask you three questions in pretty quick succession, and I just ask for your honest answer. First question: what is one red flag every investor should look out for?
We talked a lot about property management, and you hit the nail on the head when you said property management is going to make or break your deal. When you're vetting your manager, I would dig hard into the insurance side of things. That's one component that a lot of people overlook as far as coverage and where the liability is going to fall. So you want to make sure that they've got general liability. You're going to want to look at their policy limits. You're probably going to want to send it to your insurance broker and have them look at it. You're going to make sure that they've got coverage on the automobiles. You're going to want to make sure that they're having their contractors sign a master service agreement. You're going to want to make sure that they're carrying labor loss. You're going to want to make sure that they've got workers' comp. So if you dig into that and everything comes back above board, then you'll know that whoever you're working with is taking their business very seriously. That's some costly stuff. And if somebody's skimping on that, what else are they skimping on, and what have they opened up? What have they opened you up to in regards to liability? So I think that's one that not talked about enough. And for the most part, there's not a lot of issues that arise, but if you do have an issue, that could be life changing.
Yeah, exactly. The first time you overlook something within insurance is the time it's going to come and bite you. All right. Second question. What is a myth about this business that you would like to set straight?
I think it's definitely not a get rich quick, right? So a lot of people come to real estate thinking that they're going to be a wholesaler, they're going to be the next wholesaler and make a lot of money on wholesaling. It seems to be the entry point that most people that don't know what they're doing and want to get into real estate say that they're going to do. And I don't see any of them being successful with it. So I would say that's a myth. I would go straight to wholesaling as somebody that's coming into this. I think it's a myth.
Yeah, exactly. Tempering those expectations a bit and not expecting to hit like your freedom number within a year or two. All right, last question. What does success look like to you?
Success is raising some children that I can be proud of when they finally fly the nest and get out into the world, that they're grounded in some good Christian values, that they respect others, that they respect their elders, and that they care for people.
Yeah, absolutely. I know that resonates with me. I have a 4 and a 7-year-old daughter, and that's the most that I can hope for, that I've set a good example for them. And hopefully they learn something from dear old dad in a good respect.
Yeah.
All right. Hey, Mark, this has been awesome. Please tell our guests how they can get a hold of you and if you have anything else that you would like to share with them.
Yep. So I'm at Raze Capital, RAZE capital.com. My cell is 585-314-9790, 585-314-9790. And I'm finishing a book. So, hopefully you guys can pick it up on Amazon soon.
And we'll definitely have all that information in the show notes. Mark, I appreciate you coming on, and I look forward to seeing you continue to do big things on your journey to multifamily millions.
Thanks so much for having me.